Hi, thanks for tuning in to our Practical Nerds weekly podcast. I'm Shubh, and together with my partner and co host Patrick, we normally invest in founders in design, construction, renovation, and logistics technology. Many of our friends in the ecosystem wanted us to start a podcast on the built world, and in return, we decided to honor their request with a show about nothing at all. Hey Patrick, for some reason we are both wearing jackets in this episode, and we hadn't even planned for that to happen. So I don't know how that coincidence ended up happening in this episode.
I mean, what better time to wear a jacket than July in the northern hemisphere?
I know, right? I mean, maybe we should follow that up with an episode where both of us are doing the episode in sunglasses.
I'm down for it. That's okay. And actually, I was thinking, you and I, we always listen to our intro live, so we're actually not editing it live afterwards in post-prod, but we're listening to it live. And so every now and then I'm having this, maybe this is what we should say. And so this today, because we're going to talk about outcome as a service, I thought, hey, we're saying construction, renovation, logistics technology. Maybe in the future we're known as a services technology investor. What do you think?
I like it. I quite like it, I have to say.
It seems like we're a bit, I don't know, contrarian, that's an overuse word.
Singular? Singular?
Yeah, exactly. I like that.
Yeah.
Then perhaps, I don't know, other VCs, and I'm kind of digging it. So today we're going to double down on the topic.
Nice.
And take it in a direction that you suggested.
Yeah.
So let me actually kick it off with the question, Shub. So we've been discussing outcome as a service for a while online, and before we shared it online, we've been, I think, cautiously learning about why it makes so much sense in AECS, architecture, engineering, construction, and supply chains over the years. Because we've been talking about it online, I have a feeling more and more people are picking it up online. There's actually quite a bit of movement in your feeds and my feeds that is kind of. It's great to see the community actually picking up on it and abandoning perhaps some of the wrong mantras and heuristics that generic VC has all taught us. And I'm loving it. I'm here for it. I absolutely find it great. So building on that, let's perhaps explore a few other interesting details that we have learned over the years. And today, Shub, with the topic you sponsored, we want to talk about perhaps one of the OGs of outcome as a service that isn't even from AEC and many people aren't aware of, but we could learn from. So who is this OG that you can tell us about?
Yeah, so a little bit of background. So this is a conversation we were having with a founder based in the US. And by the way, there's similar conversations we've had with founders in Europe, in Asia as well, where I guess when we talk about outcome as a service or service as a service or service as a product, for this discussion, let's treat them in the similar sort of family or same family. And the reaction was, hey, are there any successful large companies that even exist doing this, right?
Right.
So in my mind, I'd always thought, hey, obviously companies as large as the ones we are about to talk about must be known, but probably not. I mean, they kind of go under the radar, which is why it's an important reminder. So important reminder at just how large of an industry we are talking about and the scale of the companies we are about to discuss today and how they could be a role model for a new generation of companies in AEC, right? So to start off, I'm thinking of companies like TCS and Infosys. So to give you an idea, Patrick, and I don't know if this will come as a shock to you, TCS is actually the world leader in outsourced IT and knowledge processing, KPO services. Think of it like outsourced white collar work. It's a 180 billion market cap company.
Wow.
Right. I think most people I meet, at least in these parts of the world, have never even heard of the name of the company. Right.
Accenture.
Exactly.
IBM.
Correct. Right. But TCS is kind of in their league in terms of market cap, but you've never heard of it, and it's like the world's leader. So if you've heard of the expression, and I don't want to say it out loud, but if you've heard of the expression like, these goddamn Indians took our jobs and stuff like that, it's a lot of times, perhaps TCS or an Infosys is responsible for something like this, where the work simply gets outsourced to knowledge workers in India. And similarly, there's another company called Infosys, which has a market cap of about 80 billion. I think at one point it was a great deal more valuable than that, but still, 80 billion is still seriously large company.
That's about the market cap that Airbnb was all like Airbnb was just past it at its peak, I think.
I see. I think you're right. Yeah. So, and these are, as you can imagine, many of our viewers and listeners have probably not heard of these names. To the best of my knowledge, neither of these companies. And by the way, we spoke about TCS 180 billion, Infosys 80 billion. There's quite a few other companies in the 20 to 40 billion ballpark, kind of replicating the same model,
Wow.
right? Uh,
Airbnb is 98. I just checked it, so it's
oh,
about the
nice.
same ballpark.
Okay, so that gives you a sense that at least in terms of market value, it's a comparable company. In revenues, I would imagine it's much larger, but nevertheless, in terms of its reach, in terms of its scope, perhaps a comparable companies are what we're talking about.
Mind blowing.
Uh, if you add up some of these companies, not just the ones operating out of India, but similar stuff around the world, just knowledge outsourcing, it would easily translate to a revenue opportunity of, I would say, hundreds of billions. Just to give you an idea, just from India alone, the annual opportunity is, I think, around 140 or 150 billion. That is that much outsourced knowledge services or IT services flow out from India to the rest of the world.
Wow.
Right? Probably there's versions of that in other parts of the world, obviously for local economies. I wouldn't be surprised if it adds up to, in revenue terms, 500 billion, right?
Wow.
So it's a very large opportunity, very valuable companies, largely hidden from, let's say, the tech community or the VC slash founder community, because it's a sector where, so none of these companies, by the way, are VC backed. That's another interesting thing to point out, which is why when we have these discussions, nobody can think of any example,
Yeah.
right? Or who has backed these companies? Is there any successful company? No one thinks of these companies. So, which I find this fascinating, and you're just talking about it. Which other industry do we know, Patrick, which is very, very large, but which is surprisingly little love from the VC community?
Are you thinking of like a 10 to 12 trillion total global market size kind of industry that VCs have shunned for almost the entire time? Does it start with C?
It does. It does. You nailed it, sir. You nailed it.
Construction. Yeah, fascinating.
Exactly. So I thought it's fascinating that, hey, perhaps, it's the story we're familiar with. It's happening all over again in a use case. It is an industry which is happening all around us, but for whatever reason, people can't think of companies, people don't think of this as a VC case. And I think it begs the question, why should that be the case? And why can't there be more of a commentary around new age companies, new set of norms or thought processes to back such companies and get them to hyperscale?
First of all, what this teaches me is that when you're in your part of the world, and mostly I think this applies to people in the Western world, it's very, very easy to get lost in what you know, the context of what you know. And oftentimes the narratives and the PR that gets pushed in the bubble you're in, that applies universally, right? And so we need to look beyond the rim in order to sometimes discover these things that we can learn that allow us to do something entirely unique, something with its own ingredients. And so should I copy an Infosys for America? God, no, I wouldn't recommend anyone do that. Because the ingredients will be extremely different than what you need, but you can learn the ingredients. You can be the chef that takes an internship at another chef's kitchen and see what ingredients they use, and then you make your own meals and your own recipes, but you've just learned a new taste. And so that to me is very important, and the light that you are shining to part of our audience, which is the Western audience, I think is super key. And secondly, I had no idea these companies were not venture backed. I mean, these would be 180 billion and 80 billion would be among the largest IPO outcomes at the New York Stock Exchange of the last 25 years in tech. They would be among the largest, which is why I was referencing Airbnb, because that was also among the largest that in the last 25 years it was produced. And you're telling me they weren't even venture backed, and VC is telling founders, oh, service businesses, not interesting businesses. What that tells me is that VC is using way too much uninformed heuristics that are not always grounded in, can I build a fantastic business? We sometimes as an industry, I think often as an industry, we get lost in irrelevant heuristics.
Yeah.
Oh, is it enough tech? That's just a heuristic for the first principle, that you're looking perhaps for something defensible or something with very low marginal cost, right? But that's the principles you should be after. And apparently, Shub, you tell me that is something that Infosys and TCS and the likes have actually found, and that's how they've built a great business.
Look, I mean, at the end of the day, and we've spoken about this before, uh, if you break down most construction companies or adjacent stakeholders, if you break down the costs as, call it material, call it other ancillary costs, and there's also always a big services component. It may not be pooled together and called services,
Yes.
but it's, consulting fees, partner fees, architecture fees, this and that, and it all adds up, right? And it's all always assumed and taken for granted as this is how it's done, which is, by the way, another feature of industries and use cases which are begging to be disrupted. And we, obviously through our portfolio and even outside of our portfolio, we have seen innovation happening on the material side, to a certain extent on the software side as well. But why should we not look at similar innovation and similar sort of disruption happening on the services side through models of all kind, by the way?
Absolutely,
Yeah.
because you're attacking these large P&L line items, and I mean, Parsons, Gensler, Arab, all the likes, they're also services companies that serve the AEC industry, but they don't necessarily, and they're good businesses, they have solid business. Number one, the largest one has 1% market share, and from there it becomes super long tail. We have just in the architectural services space 600,000 firms worldwide that serve that market. And one of the ones that I just mentioned is the biggest one with 1% market share, which means you're actually attacking a super buy-ready market where you're not up against a behemoth competitor. You're not going to take on Amazon in your quest of building a tech-enabled architectural services firm, if that's what you're doing. Not at all. You're entering a buy-ready market with super fragmented competition. That's good as a market structure to start with. In engineering services, it's way more than 600,000. I haven't done the math, but just logically, it needs to be a multiple of architectural services. And I think, Shub, anecdotally, we're seeing the same thing in every market we cover. It's usually hyper-focused, hyper-fragmented, and nobody has like the dominant market share. Because it's, in the end, if you're not software-enabled, the way it has developed, oftentimes a people business putting in person hours and nurturing relationships. But I'm curious, this specific aspect, TCS and Infosys seem to have found a secret sauce to be more scalable, to replace the one person and person hour kind of business model. Like what have they done to break out of that?
The very fascinating thing, and to be in full disclosure, I'm definitely not an expert on either of these companies. Outside in, neither of these companies looks particularly scalable, because both of these firms, and that's a very uninformed outside-in view, which is why I think perhaps we can even discuss using these role models what a new kind of company might look like. Because obviously, given the scale they've reached, there must be something that allows them to compound the way they have. So, which is why, because if you look at it, what they've developed is just it's become an organization where they offer people services and knowledge services at obviously much cheaper cost. Now, and by the way, just to clarify to our viewers and listeners, this argument is not a pitch that you need to always offer services at cheaper based on labor arbitrage. That may or may not be an option for you based on where you are. But essentially, if you have some sort of method to deliver high quality service at lesser cost, that's a value proposition that is universal and evergreen. So coming back to your question, Patrick, I think firstly the timing was quite opportune for them, as in they started in the 80s, but the rapid growth happened for them in the 90s and 2000s, when, going back to those times, computers, internet, it was exponentially increasing, and you needed ever more people to be able to, or actually, let me roll that back. More than people, you needed a ton of information to be processed and dealt with in some way, shape, or form. And you need people, qualified people who do this without dramatically increasing the cost of the service, which would then have to be, layered back to the customer. And these
Right.
companies kind of really leaned into that problem statement very effectively. And of
So
course,
you actually needed a lot of human labor to replace even more human labor through automation.
exactly, exactly, correct. Now, perhaps there's people listening to this and saying, hey, perhaps AI is a threat to companies like this. Maybe it is, maybe it is not. I'm not sure because it's, I think it would be oversimplistic to say AI replaces all of these tasks because while it is indeed services offered by people, they've also over a period of time developed the track record, another thing we've spoken about in previous episodes,
Yes.
develop the trust. And for example, if one of these firms has done projects for you over say the last 20 years, they probably know quite a few things about what you're looking for in the project delivery because probably the outcomes are also what an Infosys's client needs to deliver to another client of theirs, and probably that knowledge has gotten codified in some way.
Can I briefly hit timeout before you
Sure.
continue? Just on that point, I want to contribute something. So my hypothesis is, and I think I'm not the only one out there, so I'm not being contrarian with this. I'm not the only voice that says this, but it's my conviction as well. I actually think that most of the economic value and margin that AI will generate for the B2B economy over the next years, decade or 2 decades, will actually accumulate in the largest enterprises of the world. But I have a specific reason to say
Okay.
that. The Will AI have an impact on the small one-person shops? Absolutely. And economically, in terms of P&L, I think these one-person shops will actually see the biggest uplift in their P&L. But if you then accumulate the economic value, it will be those companies that have enough of a control over end-to-end workflows, and then the data and the taxonomy, etc., or the data structure, I should say, data structure, data infrastructure, taxonomy, etc., that goes end-to-end across those workflows, where AI can actually have the biggest transformative impact on transforming the workflow, truly automating it and doing things with it that otherwise could not have been done. But for that, but my personal hypothesis is I will benefit from it if I have end-to-end workflow control. And very few large companies actually have that, neither for themselves nor if they deliver a product or a service for someone else. It's the mega companies, and I think Infosys or TCS would qualify for that, that if they have a specific workflow end-to-end and they have done a good job at building data infrastructure for it, where the AI value will truly accumulate to a mega scale.
I love how you set me up for the response. So, in fact, I think in larger firms, handling large amounts of data where the data and the deliverables are also meant not just for the end user, as in the user who's receiving the output, but also maybe needs to then further be transferred to another party more downstream. What you're looking for essentially when you deal with a firm like this is not just, hey, someone just sort of processed the data and given it to you or done some, for lack of a better term, generic white collar work.
Yeah.
What you're looking for is, as you've all often said with outcome as a service, someone to kind of be like a project management layer on top who manages these processes, gives you a sense of predictability, gives you a sense of accountability that these things will happen at a prescribed level of quality, will always be delivered. You'll not have random goof ups and stuff like that. You always know who to hold accountable if something hasn't done, which of course again is a very clear parallel with how construction projects are done or expected to be done, which is why you can't expect a lot of these things to just be run off an algorithm, no human involvement, and just take the outcome as
Exactly.
is, because there's not enough ability to assign accountability to such a process.
Love it. Love it. I'll steal that. It's injecting account. I was always going to say injecting track record and injecting trust, but it's actually injecting accountability. I love that. Yeah, and that in the end, I mean, I cannot fire a computer. I can only fire
Yeah.
people. As sad as it is, but that's how the world works.
Correct. I mean, not to sound like a boomer right now, but look, we're talking about AI replacing jobs. The irony is, as you just mentioned, a lot of these companies rose on the back of computers and internet, Because what the rise of computers and internet did is, and by the way, if you think back to what the argument was in the 90s that computers will take jobs and so on, all it ended up doing was created demand for an altogether different kind of
Yeah.
information to become critical and for work to be done with that information. And
And
whoever offers that work as an outcome becomes a very valuable company.
and nowhere would I expect what you just said to be more visible to the human eye than in construction, because neither a computer nor the AI running on chips will be able to place a brick on another brick, will be able
Correct.
to move atoms. So all it can literally do is actually transform the work, how we're putting these atoms, how we are stacking them. So I think actually there's no place in the world where it will be more visible to us that what you just said is true than construction.
Yeah.
Right? I found it fascinating what you said about, hey, they got the timing. They got the timing right. If I'm a founder, Shub, that is listening to us and, you know, we're the Kool-Aid, we're not even drinking the Kool-Aid. Like we jumped headfirst into the Kool-Aid barrel when it comes to outcome as a service. And but honestly, I feel like we're being quite substantiated why we're thinking that. But you know, that's perhaps bias. So we're propagating this. The founder listens to us and is like, Shub, is it the right time to be building such an outcome as a service business in AEC to build something as big as Infosys or TCS? Is it the right time?
I think it might be. I think there's a few macro factors which suggest to me that now is a great time. So what do I mean by that? I think firstly, the amount of information getting created for various reasons. I mean, I don't want to throw around AI as everyone does, but just new information layers, the expectation that construction also will digitize at its own pace, and more work needs to be done by white collar workers or quasi white collar workers in construction. That expectation is dramatically increasing. I think that's one macro factor. The other macro factor, and this is by the way true across the world, more acute in the Western world, but true nevertheless everywhere else as well, there is a dramatic shortage of qualified white collar workers in construction. And it is further compounded, that shortage, with the fact that most white collar knowledge workers in construction are having to spend too much time on work that doesn't add as much value. So it's the 80-20 principle applied in a terrible way. In the sense, your top 20 people who are valuable, you need them to be employed in the most value additive work. They're doing very mundane work, which takes humans too long, and it takes up too much mind space.
And let me build on that. I'm fascinated by whenever we have investment discussions and like what partnerships to form with founders. I'm fascinated by many things, but one of the things that I'm always fascinated by, regardless of deal, is like the market discussion. Not in terms of market size. It plays no role in my thinking whatsoever. But more the market dynamics, the market structure. Does the dynamics and the structure of a market allow you to build what you're looking to build initially and then long term? And when I apply that thinking of market dynamics and market structure, I go back to something you said earlier. You said, hey, in the 80s and 90s, the customers in the West of Infosys and TCS, they were short workers to actually work with the computers to build the automation that they needed, and they needed the automation because their competitors were doing it. So there were competitive pressures, highly dynamically, but they were understaffed and didn't have access to that supply. Now transfer that into the timing question of, should I be building something like this in AEC right now, and would it allow me to be that big? So for the first time in 15 years, the AEC industry is not operating at capacity in many of the markets. There are exceptions. India is such an exception. But most of the markets were not operating at capacity, which is, we've talked about this on Practical Nerds, one of the reasons why a lot of, for example, in the Western world, general contractors are for the first time in many years investing time in changing their infrastructure. So they're now under capacity. They are also a knowledge business. People always think like this is operations businesses. Construction and AEC is not an operations business. It's a supply chain business, it's a knowledge business where you differentiate your ability to extract margin and the ability to win projects with a high margin is entirely through your differentiation of knowledge and the ability to implement knowledge into the execution. And so that means that as at underutilization, as your competitors transform, you're in a race to use your underutilization to also transform your knowledge base and the way you use knowledge in your internal processes. That time is now. That was not 3 years ago because everybody operated at capacity. Nobody changed their business. Nobody. Everybody was in run the business, but not change the business mode. Right now we're in change the business mode as much. So I have these competitive pressures. And then third, our colleague Adam likes to say we're going to build most buildings and the most ambitious buildings with the least experienced workforce. That cannot be said enough, and that is happening because workforce is walking into other jobs, is retiring. And so now in this, let's use the example of a GC, but it's equally applicable to an AE firm. I'm now having experience move out of my business. I need to differentiate via knowledge. I'm under capacity. My competitors are under capacity. Everything is changing extremely fast on the knowledge basis. Now, what's always been true, final point, Shub, is that services get procured. There's structural engineering analyses that we outsource, environmental analyses that we outsource, like a ton of stuff that the whole industry constantly outsources to service workers. So if you can build in this current environment a new age service firm that doesn't even look like a tech company, it just looks like a super or hyper reliable service business that delivers exactly what these people need, but you give them the additional promise to retain knowledge for them, I think the timing couldn't be any better.
Yeah. So I agree with all of the things you said. I'll throw in one more aspect, which I think enhances the timeliness of the need of the solution. And I think is also an important aspect of the value proposition is because a lot of these firms are not operating at capacity, the revenue line item is a bit smaller than it was. And therefore, it's a bit more important than when they undertake all these activities, they get more bang for the buck. In other words, it needs to give them some sort of cost advantage.
Right.
Right. And therefore, if you represent a player, by the way, and again, just to re-emphasize, the cost advantage can be through whatever means accessible to the firm, right? If you're able to do that, I think it's a brilliant value proposition because then what you're offering to your clients in AEC is, hey, I allow you to up your game whenever the demand picks up again, and I streamline your knowledge, make it more consistent. I own the delivery of these services to you. And by the way, all these many different line items you had, I'm pooling it together and you also get to save money whenever the demand rebounds.
I think that's well said. The one thing I want to call out here, because people who are not from the industry might come to the wrong conclusion, you cannot make quality compromises in delivering outcomes into AEC. You need to literally deliver the highest level of quality at the economic advantage that you're talking about.
Exactly.
So you can't play the game of, okay, let me get a little bit lower on the fidelity or on the quality and gaining an economic advantage that way. That will put you out of business real quick or not even get you procured in the first place.
Agreed. Absolutely.
Shub, we're also going to talk a little bit about the should I raise VC for an outcome as a service type model? Before I go there, I just want to point one thing out because we're talking about TCS and Infosys. In the last 15 years, the Western world has produced also a company that is highly revered, highly admired, that is an outcome as a service business, I would argue, and that's Palantir.
Yes.
I mean, wouldn't you say?
Yeah, I would agree.
So Palantir, I just checked it, 61 billion market cap. I think that would qualify as a company many would aspire to build. And I think, what is it, maybe 20 years old? Is it about like that? Early 2000s? I
think a little bit after the dot-com bubble, so give or take 20 years, yeah.
Right. And so today, if you look at the business, insiders would tell me, hey, the software that Palantir has built is second to none. In fact, you and I had this discussion yesterday. I spoke to someone that is familiar with Palantir, worked there, relatively high up, and they said to me, look, I mean, the great alumni out of Palantir that found businesses usually want to use the Palantir stack because they know they cannot buy the same kind of software off the shelf elsewhere. It was a fascinating insight. So what's interesting is that it's actually been started as an outcome. The reason why I mentioned this, right? It started as an outcome as a service business. It still is today, but it built the software alongside it. And so it probably has this, I see Palantir as like, they are promising the outcome. The delivery model is a little bit consulting heavy, a little bit workshop heavy. I don't know, I mean, I don't want to share this, but I think you can Google it also. Palantir has talked about at some point in the past their delivery model with the workshops into clients. I think you can Google it and you can find it. So even the delivery mode feels like a service I would get from McKinsey, for example, or from Accenture's consulting arm, right? Or PwC's consulting arm in that regard. But they deploy software to then continuously repeat the result and monitor, repeat the outcome and monitor the outcome. And that's what you should aspire to graduate to. The point I want to make here is, one, the Western world has produced these big companies too. So it's not like, oh yeah, Shub gave us 2 anecdotes from India. No. We have them too. So that's my first implication. And the second implication is, you can start building software and transition to services. That works, I've seen it. But actually the smarter sequence can be the other way around in AECS. You service into a buy-ready P&L line item, into a buy-ready process, and you do it manually, and you can do it profitably or at break even. But as you learn the process or as you internalize it, and you standardize it, and then you digitize and you build the software against. And here, I'm fascinated by that approach for one specific reason that we haven't talked about online, and we're talking about for the first time now. We had this discussion in our team. Usually when you build software, why many software companies never find product market fit or they burn a ton of capital is because as you build software for B2B, you need to make a ton of assumptions. What feature sets, what UX, what is the delivery mode, how should I prioritize these? And because I have to make these assumptions, I will be as often wrong as I will be right, and that takes time and capital. If you flip the mode around to what we were just discussing, you start with a service and you build the software alongside, you're eliminating all assumptions about your software. You're eliminating all assumptions. So literally you are going to build software that has 100% product market fit, and it is the cheapest way of building software.
Agreed. Yeah. And I think the other cool bonus, if you do it that way, is you're also training your clients to pay for the services and the outcome rather than to treat it as a SaaS spend.
Yeah. Agreed. Okay, so outcome as a service, we seem to think that the timing in AECS is good. There was this discussion online this week, Shub, where someone had a great question about, hey, if I can be profitable with service business, why should I even raise VC in the first place? And I thought that was a very well reflected question, because the answer shouldn't be universally always or always yes or whatever. What did you think when you saw that?
I mean, look, it is interesting. And firstly, self-sustaining bootstrap businesses are awesome. So by all means, if that is who you are, so congratulations to you for running such a business. So well done. Hats off to you.
TCS, Infosys, no VC.
Exactly. Or any of our viewers and listeners who are in that position. And I think some of our viewers and listeners are actually in that position. So congratulations and kudos to you as well for getting there. Now, with that said, as I guess we always like to say to people we interact with, perhaps you can, increase the size of your eventual outcome by 10x, 20x, even more perhaps, if you inject the right amount of capital at the right time. And I think that is perhaps the role to be discussed here. To also perhaps, if you have the right set of advisors and partners with you on the journey, perhaps to also, or let me tell you how I'm thinking about it. So let's say you're carrying on this journey. At some point, you might get swayed over to the dark side of accepting money, and then you get straight down a terrible path of self-destruction, right? Because it's a certain path where you're expected to show certain metrics, you're expected to burn money to show those metrics, etc., etc. But if you get in the right sort of investor at the right time, you can also prevent that from happening, because perhaps the reason why an adverse scenario like that, what I just described, is even happening is because you kind of carried on your bootstrap journey. You don't even realize or know what taking an investment actually means and what the good and the bad is. But if you take it on at the right time and the right quantum, perhaps you also, as you mature further, you develop a frame of reference on what that means for your journey without randomly getting swayed at a very critical point in the firm's evolution.
So does that mean if I cannot increase the size of my outcome and I'm already profitable, is there, will I be well served raising VC for my service business?
So interesting point. Now that I think of it, another scenario comes to mind. Suppose in your early days, look, you can of course always carve out a niche and be self-sustaining, profitable, have a good scenario for yourself. It doesn't protect you in the event that a big competitor makes you less relevant. Let's not say irrelevant, because that is unlikely, or usually unlikely in a services business, but let's say less relevant. And what do I mean by less relevant? If a big competitor comes in with a superior solution, and especially in a services business this applies, you'll have to drop your prices, right? And when you start dropping your prices in a services business, that's when it may quickly become less and less attractive over a period of time. Which is why most services businesses, which tend to stay bootstrapped, tend to stay in the long haul, tend to usually have a very selective set of clients who have their own reasons to be very loyal. Or, for instance, they're positioned as luxury services, etc., which by itself is exclusive in that sense. Or they play a cost game, although the cost game could also, if there's no other differentiator, be a race to the bottom.
Right.
One reason perhaps to take VC money, which I think would make a lot of sense, is if you envision a new services or outcome as a service business where you're envisioning an evolving product or an evolving portfolio of services, to have the buffer of VC backing to give you that, let's call it pipeline of products or services that you can develop internally to enhance your offering and make yourself more competition proof. I think that would be a very good reason to take VC funding.
I follow that. So my response and my line of thinking is very similar. So first of all, bootstrap businesses are usually more legit than the vast majority of VC-backed businesses. So my parents both built bootstrap businesses successfully, and I have a fable for that, even though my job today is a different one. But to me, it's the natural way of actually building businesses. And old school, I'm an old school venture, I like to think of myself as an old school venture person. I'm not that old, but just from the school of thinking is you take on VC for one of three things. You scale something that you have proven, you test something where you have a strong hypothesis, and you take one crazy bet. That's the three things to raise VC from. And I think for too many founders, VC has been so accessible that all of these first principles were forgotten, and it was just a go-to motion. Yeah, let's raise VC. I mean, short anecdote, I had a Construtech founder person out of a reputed US university tell me that this was 3, maybe 4 years ago, and that person said, Patrick, someone just offered me 1 million. And I said, 1 million what for? Well, there was this VC on campus that said, hey, here you go, let's sign a term sheet, 1 million, and you go figure out what you want to do with it.
Oh yeah.
I'm still thinking back to this anecdote because it represents everything that is wrong with VC, and also the founder community accepting VC in that instance. You should not accept, right?
Yeah.
But instead, old school VC is you raise because you want to fulfill one or more of these three objectives that I just mentioned. In the context of services within AEC, if you're already profitable, it probably means that you have proven one service and you can deliver this one service at market parity to your non-software enabled peers, but you might not have the software yet.
Yeah.
And so to invest in the software under the contribution margin that you have, that might leave a dent in your business. So that's the first reason. The second one is you might want to take a leap on hiring new people for that new kind of product category or service category that you want to develop because your customers told you, hey, by the way, I also want to procure this from you. But you have no idea about that service. You have not standardized the processes. You don't have the people in-house. So now you need to hire new people to tell you the process and then build software. You probably cannot do that out of your cash generation.
Yeah.
That's a good bet to take VC on if the core business that you already have is kind of stable. Doesn't have to be always profitable. Stable can also be that you're burning little. Or there could be a new market entry into a new geography where you feel like, hey, having a little bit more cash available, I probably need to take half a year or a year of a burn to enter a new market as I establish my reputation, I learn their processes, buying behaviors, etc. And I don't want to take that crazy bet out of my steady cash flow because then I would have to funnel it away from other things that I want to do with my core business. So these are like the scaling and validating and crazy experiment or crazy bet kind of logic that I think you can still have if you're a profitable bootstrapped outcome as a service business in AEC.
Agreed. I think all these are very valid reasons.
And in our portfolio, Enter, for example, was a profitable services business. I would even argue Inframarket is an outcome as a service business. It's a transactional marketplace that delivers outcomes, isn't it?
Absolutely. Yeah.
They were profitable when they raised money.
Correct.
So I think there's and I think sometimes that gets forgotten. Outcome as a service. Most transactional marketplaces are actually outcome businesses for their clients.
Absolutely. I think we've also, just to bring it around to what next happens in all of this, I think we've started to see an interesting cohort of services companies emerge, which, if things go well, perhaps could represent what the next generation of how services are offered in construction changes. I'm quite excited to see that. And I at least think, while historically it's not been seen as a VC-backed use case or VC-backed industry, I'm quite excited about what this next iteration of services businesses looks like.
Yeah, me too. And I think one additional aspect I want to discuss with you, Shub, and share with folks. We like saying around here that one of the most defensible aspects of a tech company in AECS is its reputation, its track record. And track record compounds. The more you do for a client, typically in this industry, the client will ask you for more other things. And there's a first principle reason for that. You would think it's intuitive, but you actually don't see that same behavior in many other markets because clients oftentimes want to diversify because they kind of know that they can get the exact same outcome or near enough same outcome from someone else, and then they have more economic benefit of diversifying. Not concentrating the supplier base gives them more procurement leverage, etc., etc. In AECS, the reason why people compound into one supplier once the supplier has proven themselves is because we're in this crazy, risky project type business where under a deadline, I need to deliver a project, and if I don't, the penalties are extremely high. So once I have found a supplier that is hyper reliable, I will actually go back to them and ask them if they can do something else.
Absolutely.
And because this is a people and relationship type business and the way it's operated, you always find a haggle that works for everyone.
Absolutely. Yeah, I think we've discussed this in our category creators episode, if I'm not mistaken. These are some of these wacky things which happen in outcome as a service business or category creators in construction. They look very different from the traditional VC playbook.
Right.
Yeah.
Here's a technical question for you, and you know which example I have in mind. It's a stealth company. I think we cannot share it, but
Sure.
Would you recommend a founder that is building an outcome as a service business in the early days? Should they brand like a tech company brands, or should they brand more like a traditional company towards customers?
Interesting question. I would say maybe more as a traditional company.
Interesting.
Yeah.
So taking on like a name, how a local engineering firm, for example, would also sound like.
Yeah.
Yeah, I would agree.
Or at least not very obviously a tech name, which is not a traditional name.
Exactly. That
Yeah.
also comes with a domain choice, for example, by the
Yeah.
way. It also comes with a choice of what press you put out there. So putting, if you want to do communication and PR, I'm usually a fan of staying under the radar and being stealth, but there are pros and cons
Yeah.
either way. If you do want to do PR, do it in subject matter media. Do it in like the industry media. Don't go for TechCrunch necessarily, because A, your audience probably doesn't read TechCrunch, and B,
Yeah.
if they do, they will put you into the basket of, oh, another overfunded startup.
Yes.
But they want to have a reliable supplier.
Agreed. Yeah.
So I think that's good advice. I
Yeah.
can stand behind. Okay. Shub, do you think we answered the question if you should take VC or not for outcome as a service?
I think we did. A purist may say, hey, you spoke a whole lot about other things, and you spent maybe only a couple of minutes or a little bit more directly on that question. But I would like to believe it should never be a straightforward yes or no
Yeah.
as a response on whether you should raise VC money or not. It should take into account all of the context, which is
Okay.
why I hope our viewers and listeners treat it, as a response in light of all of the remaining context of what we discussed.
Okay, good.
Yeah.
And I can summarize it also. By default, don't think of VC just by default. Two, bootstrap businesses are absolutely legit. I would say it's the way more legit form of building businesses. And three, VC should come into your equation when you can accelerate something, when you can make your outcome 10 times bigger, when you want to take a crazy bet and you can't self-finance it. Like, these are all good reasons to then consider VC for your profitable service business.
Very much so. Yeah.
Brilliant. So our little ritual, what's in your calendar next week that excites you?
So I am actually evaluating call it outcome as a service, or in this particular case, I prefer to call it service as a product company. So I'm there's like tons of jargon, dude. But hey, I mean, I'm a VC, so that's the one
We
luxury I
get to.
have, cooking up jargon as I go, right? So yeah, so looking at this service as a product company, so I find it quite compelling and interesting. So eager to dive deeper and learn more about it.
Okay.
Yeah.
I have a feeling, I have a meeting with a founder team next week, second meeting actually, that is building something like truly I have never seen.
Okay.
It's very rare that as a VC, you get to say, I have never seen anything like it. And that in and of itself, by the way, doesn't make it great. It's just, you see so much that it just happens not regularly. And so this one is building a super unique software as almost like a strategy cockpit for CXOs of building materials companies, perhaps also other companies within the AECS industry, where it accumulates an insane amount, an absurd amount of internal data from ERPs, CRMs, etc., and enriches it with external data, and then gives a fascinatingly good overview, like a cockpit, for the managers of that business. I have never seen anything like it, like what these guys have built. Doesn't mean it's a business, but it's quite interesting and intriguing intellectually.
That sounds quite refreshingly different. Eager to know more.
Exactly.
Yeah.
Yeah. All right, sir. Well, thanks for the discussion. I think we keep riding the outcome as a service train.
Yeah, we'll keep riding that one. Hopefully it's a legit train and not will not have like the outcome of many hype trains in the past.
Well, I mean, at least if nobody ever got broke by being cash generative. And so that's the beautiful piece.
Yeah.
Cool. Thank you, sir. See you next time.
See ya.